CreditWise. It's Bethany Finch with American Made Home Solutions. Today, I want to have a conversation with you about the what, the why, the when, the where, and the how of credit, both of your personal and on the business side of things. You see, so many people don't actually understand the importance of credit and or how they get credit or why it's bad or how to fix it if there's problems or challenges. So we want to address this today because there's so many questions out there and so much misinformation that we wanted to tackle it head on. So first, what is credit? Credit is simply your ability to borrow and make payments. It doesn't matter how those payments are made. They could be one-time payment, they could be monthly, weekly, doesn't matter. The terms of the borrowing ability is not as important as the fact that you're able to borrow. So, for instance, if you want to go buy a house, you need to have credit. If you don't have credit, you can't buy a house because no bank is going to loan you the money you need to buy that house. If you want to go buy a car, you need to have credit so that you can actually purchase the car on payments. If you want to pay cash for it, not a problem. Same thing if you want to pay cash for your house, not a problem. But much of society functions around this thing called credit, which is literally your ability to borrow. So let's talk about how they determine what your credit is on the personal and on the business. So when a bank or lender like an auto dealer or a lending institution of any kind, private money, hard money, any of them, they all look at you as an individual and then potentially you as a business if you're looking at business credit. But what are they specifically looking for? Well, specifically, they're looking at something called DTI. Your DTI is your debt to income ratio. So most lending institutions want to see your DTI less than 50%. Some want it to be less than 40%. And how they calculate it is quite simply, you're telling them on your application what you make, what your income is. Then they verify that sometimes with pay stubs and things of that nature. And then you turn around and you tell them your debts. So if you have a car payment, they ask you how much your monthly payment is. They ask you if you have credit cards, how much that payment is. If you have a house payment, you're telling them your debts. So then they simply add up all those monthly payments and then they divide it by the actual amount of total income that you're bringing in. So for instance, if you had $1,000 a month in payments, but you make $5,000, well, your debt to income ratio is only 20%. So that's great. They would be very happy to lend to you. But if it's a situation where your debts are, say, $4,000 and you only make $5,000, well, that debt to income ratio is a whole lot worse, right? That's like 75%. So they're not real big on lending in those scenarios. You could have a 750 or 850 credit score and still have a terrible debt to income ratio. So the credit score is not always the factor that gets decided whether or not you're going to get that loan or not. Many of us don't necessarily stop and think about why we want or need credit until, unfortunately, it can be too late. So for instance, if we never bought a house, now we want to go buy a house. Sometimes that's a little bit too late because you have to do work ahead of times to have good credit in place. So when you are ready to buy the house, you're able to get that loan. So when we stop and ask ourselves, when is the right time to clean up, take care of, build up, pay attention to, look at your credit? The answer is always right now. It's absolutely right now because we never know if your car is going to break down the road and you're going to need a new one. We don't know if there's going to be an auto accident and your car gets totaled and now you need a new one. We don't know if your family situation is changing and now you need a bigger house. We don't know if your scenario is that you want to take some money out of your home and maybe do some renovations. Maybe a mom or dad is going to come live with you and you need to build some ramps or some things. And that's going to cost a little bit of money. So you need to be able to take the money out of your home. And that's still a loan. It's a home equity line of credit. So many times having good credit available to you opens the doors of opportunity, but it can also create a sense of security for some, because they know if they have good credit and they have the ability to borrow, if worse comes to worse, bad things happen, right? Life still goes on. People still get cancer. We have medical bills, all kinds of things. Life still happens. But they know if they have the ability to borrow, then they're in a good shape and position to deal with what life throws them. So let's talk about when. That's right, right now. Right now is always the best answer. You want to be looking at your credit. You want to see what your credit looks like now to see if you need to do some work to improve it. You want to see if you would potentially be a good candidate for a loan, and if not, what it would take to get there. So for instance, we spoke about debt to income ratio. If your debt to income ratio is in a terrible position, you're going to have to do some work to reduce that debt. Or you're going to have to get an extra job or something to create extra income, right? So both parts require you to be proactive and to do something, actually take action. So it's not just going to magically happen. And that's why when is always right now. Did you know that you could make a very good monthly income or yearly income and have zero credit? Did you know that you could pay all of your bills on time and have zero credit? Did you know that you could have bad credit and never have had a credit card or a loan of any kind? There's lots of factors that happen in the credit world and in our credit reporting. And so it's very important to understand the where of credit. So there's 3 credit bureaus on the personal side: TransUnion, Equifax, and Experian. Those are the 3 that items get reported to. And there will be discrepancies between them because this system doesn't talk to this system, or this company only reported it to TransUnion, not Equifax. And so there's differences that can happen. So the where is very important. If you are following systems, for instance, like Dave Ramsey, who focus on using cash for everything, you're not building your credit. So you may be paying your bills, but it's never going to get reported because you're using cash. Cash is not reported on credit at all. So only certain items are actually reported on your credit. For instance, many utilities don't report on your credit. You actually have to ask them to report it, or you have to pay for a service to get it reported. Many times, the only items that are getting put on or reported on credit are loans, auto loans, home mortgages, personal loans, recreational vehicle loans, all kinds of things like that. Other times, it could actually be rent payments, sometimes can be reported. So the where is really important because you don't want to go through life doing such a good job, paying all of your bills, paying them on time, and still having zero credit. So understanding the need to potentially do things slightly differently is a huge asset. For instance, now they have prepaid credit cards. So if you're using a cash system, you can do things by taking your cash that you know you need to pay for these bills or whatever. You can load it onto these prepaid credit cards. You could use those prepaid credit cards online, so it would protect you. You would have the fraud liability aspect, which is important. But then you can also have a card that is reporting on you, because it would look like a credit card reporting on your credit, as long as you make sure that that particular card reports. But that's another way. You're still paying your bills. You're just doing one thing different. You're just tweaking it a little bit, right? But you can also, on the business side of things, many folks forget when they start their business, they put all of the debt and the credit on their personal, and they forget to get that transferred over to the business side of it. In the business world, Dun & Bradstreet is the credit reporting agency, as well as Experian is stepping up and doing a little bit more as well. And so it's highly possible that when you're going about paying your bills, doing a great job, but not quite getting that good credit score, that it simply means you just need to tweak one thing. And that's pay attention to who's telling who what's happening in your credit world. Because if nobody's talking because you're paying cash, then that defeats the purpose, and it doesn't build you the opportunity to borrow when you need it. So I would highly suggest that you pull up a Credit Karma, a Experian. They're completely free. Look at your credit. Sometimes it can get messed up because of identity fraud. So I had a situation where there was an identity fraud, and a hospital was trying to bill me for a 7-year-old little girl who had the same name as me. And so I had to fight that. But in the meantime, it shows up on my credit, and I had to clean that up. I had to address that, but I didn't know that until I needed it. And then I couldn't get the loan I needed because of this bad credit. So you definitely want to pay attention to it. Open it up, take a look at it, see what's going on. Do you have no credit? Okay, let's start getting credit. If you have some credit, but it's inaccurate, you got to get it cleaned up. It can take 30, 60, even 90 days to clean up some of that. So the where of who's talking, which credit bureau is saying what is very, very important. Okay, let's talk about the how. One of the most important things is, how does your credit get reported, what's getting reported, and how they use to determine it for your lending and credit capabilities. So here's an example of a credit report where this is simply one item that's reporting on a credit report. Now on this one item, it tells the credit bureau a lot of information. It tells the amount of credit that's available, how much of a balance they currently have, how much what their percentage they're using of that, what that monthly payment is. Remember, they add up all those monthly payments to determine your debt to income ratio. It also tells the age when it was opened. The age is important because that's one of the factors that they use in calculating, is all of your credit new or old. It just goes to show if you're brand new to the credit world or if you've had credit for quite a while. It shows your payment history, which your payment history is just as equally important, if not the most important thing, because it is 35% of your credit score. So it is a very important number to pay attention to, is your payment history. It also tells them here, clearly this is a business credit card, so it should be reporting on the business credit. But if you look, see this where it says responsibility, individual. So because it's classified as an individual, it's going to report on the personal credit. And that's something that you would want to get taken care of and have it pushed back over to the business side so it's reporting on the correct side. If you're not able to do that, you just need to remember that every time you use a card like this that's reporting on the individual, it's going to affect your personal credit, even though it's maybe in the business name. So these are things that you want to be paying attention to. And if you never look at your credit report, you have no idea. You have no idea if things are reporting accurately, like in this case where it's showing incorrectly. It's showing the responsibility as the individual instead of the business. So you have to get that changed. A computer is not going to fix itself. It doesn't know. It only does what it's being told. And all the credit bureaus and agencies, it's all computers. It's just a computer talking to another computer. So it's very important that you understand how they use this information in determining if you're a good candidate for a loan and how much. Remember that debt to income, when they're going by all the monthly payments and how much money you bring in each month, is very important. So many people live their life working and hard and doing a great job, and then they retire. What happens when we retire? Oftentimes we don't have any more income. We may have a pension, but most people are unaware that they don't count pensions as income. And so so many times Social Security is not counted as income, and different disabilities are not counted as income. And so if they're not counted as income, you could be setting yourself up for disaster come retirement because you can never get a loan. Maybe that means you're always going to have to save up all the money you need to buy cash for a car, or you're going to have to save up to buy that investment property you want or vacation home. Whatever it is. So it's very important that you understand that, because the income side of it is just as equally important. You want to structure your retirement so you're not setting yourself up for failure. Again, life still happens, right? We still have medical bills. We still have things that can go wrong, cars that can break down, houses that can fall apart or need insurance and things like this. If you lived in the state of Florida, your insurance rates doubled this year. So it's very important that you understand, because, for instance, if you had a property that you never had flood insurance on and you waited to get it, and now you decide, well, I better get it, and the price is now doubled, if you weren't paying attention to that, that may be a very big hardship for you. And so you want to be aware of your ability to borrow and set yourself up for success. Now, the good news about this is we have 2 programs that are absolutely phenomenal for personal and business credit. So with those, we have the personal side of things where you can learn more about setting up personal credit, building personal credit, and repairing personal credit. Sometimes in this situation where something is simply reporting incorrectly, how do we go about correcting that? What does that look like? What are we supposed to do? That's our personal credit side of things. We also have a phenomenal program called our business credit program. And our business credit program teaches you how to set your business up correctly in a way that you can establish business credit, and then how to build that business credit. It doesn't happen overnight. It takes time, and it's a process. And to do it on the business side is a much slower process than the personal side, because many companies don't report for business credit. And we want you to be able to have that accessibility. The banks look at things the exact same way as the credit cards do, and vice versa. So if you're just thinking you're just going to go into your local bank and you're going to get a business line of credit, well, I got news for you. If you haven't set things up correctly, you won't. So it's very important that you set your business up for success by establishing business credit and building and working that out. So as your business grows, you have the capability to keep growing right along with it. So both of our programs are available to you by clicking the link below. When you do so, you'll have the opportunity to purchase the program and do it at your own pace whenever you want, so that you can set it up for success, whether it's personal or business.